Welcome to your SIE Exam Study course. Today, we are starting at the very foundation of investing, equity securities. Equity securities, or stocks, represent ownership in a company. When you own stock, you own a piece of that business, no matter how big or small your share might be. Understanding how stocks work, the rights they confer, and the risks they involve is essential for both the SIE exam and your future career in finance. Let's begin by defining exactly what a security is. A security is a financial instrument that represents ownership, a creditor relationship, or rights to ownership. Stocks, bonds, options, and mutual fund shares are all securities. However, commodities like gold and currencies like the dollar or euro are not securities under securities laws. Securities are special because they carry legal rights and are regulated to protect investors and ensure market integrity. Now, let's focus specifically on common stock. Common stock is the most basic form of equity ownership. When you buy common stock, you're buying a direct stake in a company's success and its risks. Owning common stock provides several potential benefits. First, if the company grows and becomes more valuable, your shares may appreciate in price, allowing you to sell later at a profit. Second, you may receive dividends, periodic cash payments, if the company decides to distribute profits. Third, stocks are highly liquid investments, meaning they can usually be bought and sold easily through public markets. Finally, as a shareholder, your liability is limited to the amount you invested. You cannot lose more than the amount you paid for your shares. But common stock also comes with risks. Stock prices can be highly volatile, and you could lose part or all of your investment if the company underperforms or market conditions deteriorate. Dividends are not guaranteed, and in the event a company goes bankrupt, common stockholders are last in line to be paid, after bondholders, creditors, and preferred shareholders. Let's dig deeper into types of common stock. When a company is formed, it authorizes a maximum number of shares it can issue, called authorized stock. When the company sells some of these shares to investors, those become issued stock. The shares that are still actively held by investors, after accounting for any shares the company has bought back, are called outstanding stock. If the company repurchases some of its issued shares and holds them in its treasury, those shares are called treasury stock. Treasury stock does not pay dividends and carries no voting rights. It's important to know, outstanding stock equals issued stock minus treasury stock. Now let's turn to the rights of common stockholders. Owning common stock gives investors important rights. First, the right to vote. Stockholders typically vote to elect the board of directors and on major corporate actions like mergers. Companies may use different voting systems. In statutory voting, shareholders cast one vote per share for each board seat. In cumulative voting, shareholders can pool all their votes and allocate them however they choose among candidates, giving smaller shareholders more influence. Second, shareholders have the right to freely transfer ownership of their stock, unless restricted by agreement or law. Third, they have the right to inspect certain corporate records, like financial statements. Fourth, stockholders have the right to receive dividends if the board declares them. Finally, stockholders have a residual claim on the company's assets in the event of liquidation. However, they are paid only after all debts and preferred shareholders are satisfied. Now, let's discuss the benefits and risks of common stock. The benefits of owning common stock include the potential for capital appreciation, the chance to receive dividends, liquidity through secondary market trading, and limited liability. The risks include market risk, meaning the stock's price could drop, business risk tied to the specific company's performance, and the risk of receiving no dividends. Also, remember, common stockholders are last in line during bankruptcy proceedings. The SIE exam often tests these benefits and risks side by side. Make sure you can identify them quickly. Now, let's introduce preferred stock. Preferred stock is another type of equity security. Preferred shareholders have priority over common shareholders when it comes to dividends and in the event of liquidation. Preferred stock typically pays a fixed dividend and behaves somewhat like a bond in terms of its steady income. However, preferred shareholders usually do not have voting rights. There are several types of preferred stock you need to know. Cumulative preferred stock requires that missed dividend payments be paid before any dividends can go to common shareholders. Non-cumulative preferred stock does not have this protection. Missed dividends are lost. Participating preferred may allow shareholders to receive additional dividends if the company performs exceptionally well. Convertible preferred can be converted into a set number of common shares. Callable preferred can be redeemed by the issuer at a set price after a certain date. Preferred stock provides income stability compared to common stock, but offers less opportunity for capital appreciation. Quick review. A security represents ownership, a creditor relationship, or rights to ownership. Common stock gives ownership rights, voting power, and potential for growth, but comes with greater risk. Preferred stock offers income stability and priority in liquidation, but usually no voting rights. Investors must balance the benefits and risks of equity securities based on their personal goals and risk tolerance. Mastering the fundamentals of equity securities will give you a strong foundation for everything else we'll study in this course. In the next unit, we'll build on this by exploring debt securities and investment companies, learning how bonds, mutual funds, and pooled investments work. Stay focused. You're off to a strong start.